How's it going, everybody? It is Potter Socks, and I am going to go over briefly why we took Tesla on my birthday, actually May 18th. The logic behind this trade, and a little bit of things that you can pull from this trade that will come in handy later on. And of course, this is a trade taken using the Potter Box method, nothing else. This is the only thing that I trade with. If you don't know about the Potter Box or PBS strategy, it is on YouTube. It was a live class, so of course you're going to have to kind of roll through it. But I will be making and dropping a new video just on the Potter Box alone. Doesn't have any other participants involved. But first off, let's just go over Tesla. So overall, we need the market to be moving up. This is SPY, QQQ. This is happening in the background. So economic events aside, and just looking at the price, one of the first reasons that I saw this trade was because it had punched back into a box. And what I mean by that, if you don't know what that means, is typically in a Potter box, we want to find our area of sellers, right? This is where sellers try to keep the stock down, or they control that price, right? And when they lose control, typically you're going to go and you're going to test the next area or your next resistance, and that obviously happened to be 177. When you retested, and these are signs that we look for, of course, all candles close underneath this. Then we see the double retest off of that mark, the wick right here showing us that was the resistance. Of course, if you fall back in to a Potter box, you will always go and make a new low if you break cost basis. So in any box, there's going to be what's typically hovering around or near the 50% mark. This is called cost basis. And this is where either buyers or sellers let you know whether they like the price. So if you were to bounce off of that cost basis, the chances of you going back up still remain. But once you cross that, ultimately you will always make a new low. And this sets up for a great play on anything. This is a mechanical feature in the stock market. So underneath that 170 psychological number, we go and we punch back down and retest the Potter box underneath us, right? And this is just, again, another word for an area of consolidation. It's the way that we use it is why we call it a Potter box. So we test this twice, then reclaim the box above us. We can see that by breaking up and holding. So these candles, these wicks, they stay on top of that 167 price. From there, we break cost basis. Now, this makes a great entry because what we know is, again, this is mechanical. We know that if we test a low, reclaim the area of consolidation above us, and break the cost basis, you will make a new high. So our job is to go find that new high. The first new high there is 177. But obviously, this has been an area where price was consolidated. I was looking for a break. And of course, there's higher time frame analysis that I can add to this as well that makes all of this a little bit clearer. But again, we're focusing on the price here. So on May 18th, I had obviously missed the entry at 170. I had missed the initial retest or bounce off of 173. So I decided towards the end of the day, right around 1 o'clock, right on this arrow, that I was going to go ahead and buy while it wasn't moving at all. And typically, it's a great time to move into a longer expiration contract. A lot of the IV, open interest, everything is settled down a little bit. So you're kind of able to sneak in there and remain undetected, if you will. Anyway, from there, I am expecting a new high. And of course, this is something that, again, I was looking at on a higher time frame. So we're looking at the same area. I'm entering right here on the top of that box. You'll notice that on the higher time frame, it shows the top of that box really clearly. This is why we use multiple time frame analysis. But we can see that one candle opens above, you do go test a high, and then you come right back down. In this case, you open multiple candles above that 175. And this is, of course, we know this is going to happen because it triggered a punchback. So from this point, I have located a gap. This gap just happens to be cost basis in the box above us. So this makes a great target. But what I'm also thinking is if we break that cost basis, that's going to trigger another punchback, right? You made a new low, you reclaim the box above you, and therefore you make a new high. And our job there is always to go locate where those potential new highs were. And of course, our target, if you guys traded in our Discord with me, the target was perfect. All TP marks, the weeklies went crazy, next week's went crazy, and a lot of people had some really awesome trades. We were also able, and this is definitely worth mentioning, we took the June 30th 205 strikes, and we bought these at $220. A couple of people had varying averages, but $200 is what those were averaging around. So we bought those for 200 June 30th. Great expiration, great delta, great Greeks in general looked really good. And of course, we knew that we had a perfect stop loss. So one of the best features about the Potter box is that it gives you your entry, exit, and stop loss. So once a candle opens above 175 with the right expiration, and because I am looking at a higher time frame, I am needing a higher expiration. So with that 205 strike, buying above there, my stop loss is underneath 174.62, minimal losses, and I can use the hourly candles that push underneath that mark as my stop loss. But regardless, we're looking, and we're not focused on just hitting the box above us. We know that we're looking to go make a new high, but of course, we're not in it for just chump change. We are looking on a higher time frame and seeing the potential for gaps to get filled, punchbacks to get triggered, therefore new highs potentially. And right now I've got targets around 214. So the main thesis, or the main reason that I took this play, was that we revisited this location below us. And when we did, we bounced off of it and we reclaimed the box above us, triggering a cost basis break or a punchback at 170. So while I may have been late, I was still able to use this structure to get into this trade. And of course, again, I have higher expectations for this. I have a daily channel, right, that was on Tesla, and this whole thesis is posted in my Discord. But this higher time frame channel, we lost it. This is a form of control, right? And it's not hand drawn, it's off of math, right? That we have, it needs to line up. And once you lose control of a channel, typically something bad has happened. And him taking over Twitter, all of the FUD surrounding that, definitely, and then them selling as well, definitely didn't do them any good. Since then, we have punched back up, and we have reclaimed that channel. He has handed the keys over to somebody else on Twitter, and therefore that frees up the potential buying for what is the Tesla mob. So anyway, I have a higher time frame, and this is the beautiful thing. It's a fractalized strategy. So if you find a higher time frame box on the weekly, this is something that can still play out. And you can use lower time frame Potter boxes to get in and out of those trades. But here on the daily and the weekly, right, we are punching back into another box, and we finally broke cost basis. So we're expecting even higher highs. Right now, I've got 216.34 targeted, and I'm still holding those June 30th. I did roll a couple of them out, but this is one that I'm going to continue to trade, and I have high expectations as this one has a gap around 266 that I would like to take. But anyway, hopefully you were able to kind of get the general consensus of why I took this trade. And of course, lower time frame analysis helps me get in and out of these trades and day trade around my higher expiration contracts. So that way, if I see a lucrative trade like we did on Friday, I gave everybody an entry mark right at 186. Again, this is a lower time frame punchback potential, right? We've got a Potter box here, and we punched straight through cost basis. We were all bunched up inside of an area of consolidation here, with the floor being right there, and we didn't even quite make it. We were riding a nice support up to the upside, broke that 186 stop loss for that trade on a lower expiration, was just right there under those wicks at 185.86. And if you had dropped under there, no bueno. But we shot straight up, and I gave some ridiculous price targets like $200, and I expected possibly 201, and I am still thinking that we maintain this what is still a speculative channel and a form of lower time frame control. So if you have any questions about what I just went over or any of the words that I just used, by all means, you can message me on Discord. The link is in my bio on Twitter, TikTok, etc., etc. But otherwise, this is probably going to be one of my main trades going into the rest of the week. So anyway, you guys have a wonderful weekend. I'll see you guys on Tuesday.